Hello everybody. So today, for the first time on the channel, I am going to compare the valuation of Tesla compared to a bunch of other mostly EV companies, because I have put BYD, Ford, GM, and VinFast in there, and they all have some hybrid and some gas going on. It's important to point that out. BYD has hybrids, Ford and GM is still mostly gas cars, and VinFast has a history of gasoline cars. But aside from that, all of the rest is EV companies, and of course Tesla is an EV pure play. And kind of a subtitle of the video was, prepare for bankruptcies. And you can clearly see that when you have such negative margins, when if you take say minus 225%, so that what that means is that if you sell a car for $100,000, you're losing $225,000. Bankruptcies are coming quick unless you can get more financing, right? And in the case of Lucid, it's getting financing from Saudi Arabia. In the case of RIVN, it's getting financing from Amazon. I don't know if Jeff Bezos is very keen on investing in all of that stuff. If you're talking about Fisker, I don't know where would the financing come from for Fisker, which means in my view, Fisker is likely not going to make it. But anyways, where I could, I have calculated my enterprise value over gross profit over revenue growth and number, right? And actually comparing the number of Tesla compared to other companies in the auto sector makes Tesla look very good. I mean, granted, BYD looks even better, but it makes Tesla look very good at a 1.05. When I compare Tesla to all of the other companies in my spreadsheet, my usual bi-weekly spreadsheet where I cover all of the stocks ever covered on the channel, Tesla often shows up as one of the more expensive ones. Today, Tesla is not the most expensive. If you compare Tesla to Ford or GM, it's much more expensive to buy Ford and GM than to buy Tesla because they have next to no future growth. So anyways, Tesla in an absolute basis is a little expensive. But of course, the problem of all of the EV companies is that these numbers are going to be flawed because of the revenue growth not manifesting in a high interest rate environment. So Tesla, to the most conservative numbers that I've seen, to the best of my ability, I can say that Tesla may grow revenue 20% this year. And their gross margin, assuming they do the same, assuming no increase in gross margin, they'll be at 19% in gross margin. Now, people who analyze Tesla say, the gross margin will go back to 23, 25, maybe even 26%. We'll see. And the EBITDA margin of Tesla is 9%. So you get almost a rule of 40, not quite at 29, but it's still close. And of course, when the revenue growth resumes towards the 50% year-over-year growth, long-term growth rate for Tesla, when that resumes, and I have no doubt that it will resume and go back to 50% a year-over-year growth, when that resumes, of course, all of the numbers will look better, whether it is the rule of 40 number or the EV over GP over RG number. And if it's worth mentioning, I've been adding to Tesla because guess what? Tesla is now my second biggest position, right? It lost to Bitcoin. Unfortunately, now my Bitcoin position is much bigger than my Tesla position, and it's actually much bigger than my Tesla position because Bitcoin doubled in a matter of, 2 months. So unfortunately for Tesla, they're not my number one position, but I am working on it. And at $175 a share, I'm thinking at some point it will be my biggest position again, unless, of course, Bitcoin keeps rallying, which is likely in my view. Moving on to BYD. So BYD is the one company that gets a lot of praise from industry experts and from Elon Musk himself. BYD is the embodiment of the Chinese EV manufacturer, and they release very inexpensive models, similar to what the Model 2 from Tesla is going to be when they release it in 2026. And that's BYD for you. And as a result of that, as a result of having cheap models, BYD is doing very well in China, and they're doing well in Europe, and they may get to Mexico soon and to the United States at some point. They're waiting for the election to be over. But because of that, BYD is predicted to grow at 47% 47%. The gross margin for BYD, interestingly, is the same as that of Tesla at 19%. And of course, they are dirt cheap, and that is the nature of Chinese stocks right now. Any Chinese company is going to be very dirt cheap because many investors, if not most investors in the US and in the West in general, have this general general rule of we don't touch Chinese stocks. We don't invest in Chinese stocks. And that's probably the reason why it's at the 0.1, because it's a Chinese stock. You may remember my video on e-commerce stocks a few days ago. Same thing. Pinduoduo was very, very cheap. Baba is very cheap, but people don't want to buy Chinese stocks. So that is something that you have to answer for yourself if you would be interested in buying BYD or not. I myself have this habit or this policy of when I invest in one sector, I want to buy the best player in that sector, not the second best, the best. I think there is no denying that Tesla is the best EV companies. That's the one I want to own. Just like the video I made yesterday about CrowdStrike. Why do I only own one cybersecurity stock named CrowdStrike? Well, that's not true. I own Zscaler. It's in a different space. Why do I own CrowdStrike? Because it's the number one. It's the number one by a long shot. They are superior to the secondary and third option. And same for Tesla, right? The only EV stock that I own is Tesla. But I gotta be honest with you, if I were to consider another one, it would be either BYD or Polestar. And I think Polestar might actually be very interesting. I'll get to it in a second. Before we move on, we gotta talk about the two legacy auto companies. And the two legacy auto companies, as you can tell, are very expensive on my EV over GP over revenue growth basis. And really the rule of 40, I mean, it's great that it's not negative, right? Because we got a bunch of startups that are well into the negative. So it's great that they're not negative. But let's face it, these companies are making money right now. Ford and GM, they're making money because of their legacy products, because of the trucks, because of the chicken tax, right? The 25% tax on foreign trucks is one of the big reasons why they make so much money on these big machines. Ford, for example, has almost entirely exited the car segment. And same for GM, these short cars like the Ford Focus or the Ford Taurus, they've mostly exited all of that. They do big vehicles, expensive vehicles with high margin. And of course it shows because the gross margin is 9%. So we can see they've achieved high margin, 11% for GM, right? Even better. But what hurts them is two things in my numbers here. And by the number, I mean the EV over GP over revenue growth. So what hurts them is, one, the revenue growth. Ford 6%, GM 4%. These are companies that are not growing anymore. They are growing roughly at the rate of the US economy, which is not much right now. So they're not growing anymore, at least not much in the auto sector, because the auto sector, of course, is in trouble because of interest rates. That's one problem. Another problem is enterprise value. If you look at the enterprise value of Ford or GM, you'll notice that it's extremely high. And you may look up these stocks and you find the market cap is, under 50 billion. Why would EV be so high if the market cap is under 50 billion? Because these companies have loads and loads and loads of debt. They engage in revenue financing. They have debt for their factories, debt for their plants, debt for their pension plans. They have debt. They have a bunch of debt. And of course, in my spreadsheet, I am going to penalize companies that have a lot of debt, right? And it will be interesting to see what's going on as they need to do more and more revenue financing type deals to sell cars in the future. How quickly is the debt going to grow for a Ford or a GM, and maybe the strategy of a Ford or a GM, of course, is the bailout strategy like happened in 2008. Well, for GM, not for Ford, but for GM. So maybe that's part of the strategy. I don't know. But they have tons of debt, which is not something you see in BYD and not something you see in Tesla. These companies are essentially debt-free compared to the size of their balance sheet. Now, let's talk about other companies which actually have some cash. In the case of RIVN, they have some cash, but they also have debt, and they're going to get into more debt in order to ramp the R2. So when this video comes out today, there should be the R2 introduction sometime on this Thursday, and the R2 introduction, we'll see if it's going to be a good car, but they need they really need to hit it out of the park with this R2 presentation. It needs to be viral, right? It needs to be all over the internet. The market needs to get excited about that car. And that car, it's worth mentioning, is not going to hit the bottom line and even the top line, all right? The top line of Rivian is not going to hit the top line of Rivian until 2026. And so this is a company which, in my view, if they don't do a major deal for financing, they may run into problems, because you can see the negative gross profit. They burn about $2 billion a year. It's actually more than $2 billion a year that they burn. And so that cash on the balance sheet, could last them about 2 years, perhaps just enough or two, but really not, because companies like to have some cash aside in case there's a lot of uncertainty. And if you look at Rivian, if you listen to the Rivian call, the latest call, that the customers are not really rushing to get the cars. And actually, to the best of what I can see and read and the estimates of analysts, I believe revenue for Rivian will be actually 5% down compared to what it was in 2023. Now, Lucid going from bad to worse, and Lucid is just I don't know how to explain it, right? Lucids are expensive car, right? I mean, they have a inexpensive version, but your average Lucid is going to be about $100,000. Like I said, $100,000 car, if you have a gross margin of minus 200%, you're losing $225,000 on every car you sell. So you're in the business of running a charity. You're not really in the business of running anything. Ramping is so dangerous for these car companies because they need to have the cash to finance the losses. And Lucid is the same. It's going to run into that cash burn that they have. They're going to run into that issue. And of course, both Rivian and Lucid, they want to be the high-end players. But guess what? Everybody wants to be the high-end player. So does Fisker. So does VinFast, right? Everybody wants to ramp by being the high-end player. That doesn't mean that it's what people want, especially in high interest rates environment, right? In high interest rates environment, people don't necessarily want to buy a high-end car. They want to buy BYDs, like the BYD Seal, for example, some of our more entry-level vehicles of BYD, or they want to buy the Tesla Model 3 right now, which is a fairly inexpensive price for the refresh, right? At $38,900 in the US. It may be cheaper in your area. And they want to wait for the $25,000 Tesla Model 2, which of course Tesla is not communicating on, because if Tesla was communicating much on that car, then people may be waiting for the Model 2 and you would have some Osborne effect and people not buying Model 3 anymore. But Lucid, the same story as Rivian. Rivian needs to get money from Amazon and Lucid needs to get money from Saudi Arabia. Or as some have suggested, I've read quite a few things about Lucid. Some have suggested that simply a lot of players are waiting for both Rivian and or Lucid to go bankrupt, and then they'll just bid at bankruptcy court and try to acquire these companies at bankruptcy court. So, but if you're a shareholder, it's a problem, because if the shareholder gets wiped out at bankruptcy court, in the eyes of the consumer, they may say, oh yeah, Lucid's gonna make it, Rivian's gonna make it, yeah, the brand is gonna still exist, but the shareholders could be wiped out, and that is if they don't get financing, and they gotta get more financing, I would argue. Otherwise, they're gonna run in trouble. The same is true for VinFast. So VinFast is actually a Vietnamese manufacturer. Interesting growth story. They have partnerships with dealers in the United States, and they try to sell it in California and sell it through a lot of dealerships. And they have actually a lot of models, a lot of vehicles. Interesting company, interesting underdog story, as some would call it. Nonetheless, they still lose money on the cars. You still lose minus 46% gross margin. So if you sell $100,000, you're going to lose $46,000. So they still have that issue with ramping. Now, the big advantage, and this is true for both Polestar and VinFast, their base is very low. And to the best of my ability of what I'm able to say, those revenue growth numbers are correct for both Polestar and VinFast. So if you grow 75% in 2024 and 89%, because you're starting from such a low base, if you grow from these levels, that's a major positive for these companies if they can actually achieve these levels of growth, because they're the new thing, they're a novel company. I've never seen a VinFast on the road. Polestar, I've actually seen one, but that's because I live in a big city. Most people who live in smaller cities that have likely never seen a Polestar on the road, right? These are brand new vehicles, and so they have this novelty, this ramp. It's kind of the same story for the Tesla Cybertruck. Yeah, Tesla has demand problems for the vehicles that have been around for a while, like the Y and the S, and even then I would argue it's not really a demand problem. It's more people postponing the purchase, but they have no demand problem for the Cybertruck, right? So novelty drives demand, and for whether it is VinFast or Polestar, clearly the demand is there for these two companies. Now, the problem for VinFast is that they still lose money on each car, and an enterprise value over sales basis, you're at almost a 16, which is quite expensive, and again, everything's negative. Your EBITDA margin is negative. Your rule of 40 is also negative, which is definitely not what you want. So some risk, quite a bit of risk, whether it is RIVN, LCID, or VinFast, which has, I would argue, and we'll get to Fisker. These four, I would argue, they have very imminent risk. Ford and GM, I would argue, watch out for the debt. Watch out for people returning the Ford Raptor at $90,000 and not turning that lease into a purchase after 3 years, and returning that Ford Raptor and not purchasing the truck and moving on to electric. And then Ford has a bunch of trucks on their hands. And what do they do with that note? What do they do with those loans, right? Who takes the depreciation of these leases? Leases are very dangerous for companies, because you could see a precipitous drop in the value of, say, gas cars or gas trucks if electric trucks become a thing. Because let's not ever forget that the main reason why anybody would get a gas truck is because it costs 1/10. The price of electricity to fuel a truck is 1/10 what it is to fuel with gas. It is 10 times cheaper. And so, of course, people at some point, they're going to realize, well, I really don't want to spend $300, $400 a month on gas anymore. I really want to spend $30 on gas now. And by gas, I mean electricity. So that's one of the major aspects. So I would argue, be careful about that, right? Ford and GM, that's a medium-term risk. And then BYD, BYD and Tesla, in my view, they will survive and they will even thrive. The way I look at this. Now let's look at the interesting company to me, which is the Polestar. I find Polestar very interesting. First of all, their gross margin, trailing 12-month gross margin, was 3%. So that's noteworthy right there. That's very good. I mean, if you compare for a company this young, if you compare it relatively to Levions, they actually have 3% gross margin. And they're talking about being free cash flow positive by 2025, by the end of 2025, and they are currently negotiating some financing to get them there. So Polestar, in my view, and these are way out of the risk curve, right? These plays are way out of on the risk curve. But if I were to take a risk or be interested in taking a risk, I think Polestar might be interesting as far as risk goes, because the product has a lot of demand. It's projected to grow for 89%. I've actually seen a Polestar on the road, and I got the same feeling seeing a Polestar on the road as I have had seeing a Rivian R1T. They look good. They stand out. These electric vehicles stand out. Much more than, say, the F-150 Lightning, who just looks like any other Ford. They stand out, not quite like a Tesla, but they do stand out. And so I see why there could be demand. And if this company is poised to survive thanks to the extra financing, and if we see quarter after quarter that the growth of the Polestar vehicle really picks up, I think this could be an interesting play. Now, there's also the issue of valuation. That valuation is it's twice as cheap as Tesla. But the question is, should the valuation when I calculate it, should it really be closer to a BYD? And that's where some people would argue it should. But nonetheless, interesting. And if you look, of course, at their rule of 40, they achieve a rule of 58 because they lose money, obviously, but the growth is there at 89%. And lastly, unfortunately, the company that I think I'm the most confident, unfortunately, will not make it is Fisker. So if you look at Fisker, if you look at the reviews for their car do not hold up. Look at Dog Tomorrow, or look at Autofocus, right, is another big channel by Marques Brownlee. If you look at the reviews of Fisker, the review's not good. The review's not good. At least RIVN or even Lucid, they have great reviews for their cars. Like, at the very least, the cars get great reviews. If you don't even nail the product, if the product doesn't get great reviews, then it's very problematic. And to the best of my ability, I am forecasting that the revenue growth for Fisker is going to be minus 50% because they've overproduced. They've actually sold only more than half of the vehicles that they've produced, which tells me that the demand is not very strong for a Fisker product. And the gross margin at a negative 37% is still very high because Fisker actually does not produce the car. They have the cars produced by some company in Europe. They actually don't make their car. They don't have their own manufacturing factory line, and they're still losing 37%. Enterprise value over sales is 80.88. I mean, it's under 1, so it's cheap. Company EBITDA margin is minus 122%. So the rule of 40, well, it's a minus 172%. And Fisker, I've watched a few things, read a few things. They have a new strategy. They're trying to go through dealers a little bit like VinFast is doing, kind of going through a distributor, kind of going backwards. I mean, it's understandable that these startups are doing all they can to survive, and Tesla really started a price war by reducing the cost of these vehicles so often and so hard, and of course BYD can compete. BYD takes on Tesla head-to-head on pricing in China, and that's good for China. In the US, Tesla is the almighty leader. Ford and GM retrench, right? Ford and GM do not compete with Tesla when it comes to electric cars. What they can just do, Ford and GM, is they can just dial down. They can just be like, okay, well, we're just not going to push electric cars. And we saw Ford, for example, close one manufacturing line for the F-150 Lightning. It's possible for Ford and GM to just retrench and like okay, we're gonna double down on gas cars, and that's clearly what they're doing, and that's how they are surviving. But companies like RIVN and Lucid and Polestar and VinFast, they can't do that, right? They have to go get more financing. And for Fisker, it's a tough one. It's a tough one. So if you look at Fisker, always maybe start by looking at the consumer reviews, and if you look at the consumer reviews, they are generally stellar, absolutely stellar, generally for Tesla. They're generally very good for RIVN. I've heard good things about Lucid. If you have a good product, you can draw people in. But then once you draw people in, you're going to scale. And when you scale, you lose a bunch of money. So you need to have investors who finance these losses. And then you need to make it through that threshold, through that minimum volume, to where you get to positive gross margin and then positive EBITDA, right? Positive EBITDA. And so these companies, that's another point. If you look at RIVN, for example, it's great that they're launching the R1T, but what is that? The R2. They're launching the R2. But think about the ramp of the R2 at the same time of trying to make money on the R1 models, the R1 variants, right? So it's going to hurt your EBITDA even more than it's going to hurt your gross profit, because think about all the R&D that's going to have to go into designing this new car and getting this new car started. And if you look at a company like RIVN, they have all of these other plans. So your R&D, your marketing spend, all of that spend is just gonna hurt your bottom line at a point where you haven't even achieved positive gross margin on the top line, which is for me, it's a hard pass. For me, if a company doesn't have positive gross margin, it is going to be a hard pass for me. Same for a company that has negative growth. It is a clear hard pass for me. So anyways, hopefully you found this to be interesting. I think this teaches us a lot about this market and about really where Tesla stands in there, which is what I think most of us might care about. And you would care about this just because of the weight of Tesla in the indices, right? And many of these stocks are priced for bankruptcy, and some of them, could be argued it's closer to a gamble than it is to an investment. And that's one style of investing. That's a fun style of investing, but it's not what I do. I try to go for growth and a lot of growth, but I also do want capital preservation as well. So this was not investment advice, no financial advice, no car buying advice. This is just entertainment. I'm just trying to entertain you. Please like, please subscribe. Thank you for watching and have a wonderful day.